There we go. Hey Wes, how are you doing?
You alright?
Yeah, I'm good, thanks, mate. It's only just popped up, so there we go.
Mm,
There we go.
okay.
So welcome everyone to Value Investing Unleashed on live on YouTube and Instagram at the same time. Wes has still got painters around, so yeah, maybe on screen next week or the week after. Who knows?
Yeah, yeah. Um, today we're going to talk about a few topics. So we're going to talk about Games Workshop, Kiwi, what to do when you're struggling with investing ideas, how can someone be a value investor, and what is the most difficult thing about value investing. And we can first start with Games Workshop. Do you mind talking about that, Lewis?
Yeah, sure. Let's go for Games Workshop to start with. Games Workshop stocks. Yeah, a bit about the business itself. If nobody really knows what it is, Games Workshop is a company which makes Warhammer. If you've ever heard of that, it's basically kind of a board game. Yeah, it's a company based in the UK. It designs and manufactures and sells fantasy miniatures and games related products. So it sells games and products related to the Warhammer brands and a few others as well. Also has some video games as well, which I think they license out. But yeah, they sell these products worldwide, in Europe, North America, Asia. So it's quite, surprisingly, it's quite popular. So yeah. Anyway, that's a bit, a bit about the business anyway. But
Yeah.
what's attracted me about the business is how high quality it is. The financial numbers behind it. It's some of the best I think I've seen. Especially from a UK company. Some of the numbers on there. I remember when I was looking at it, I was thinking this does not look like a UK business at all.
Yeah. I was pretty shocked myself, to be honest, looking at it.
Yeah, it's really interesting. So yeah, if we do have a look at some of the financials, I'll get them up from my YouTube video I did in November. So yeah, I mean, I think the thing that stands out the most is how profitable the business is. So it's got a gross margin of 70%, average of 5-year average, and then a 5-year average net margin of 27%. And I think you'd agree, Wes, that is pretty damn good, isn't it?
Yeah, definitely good. That's brilliant.
Like, that is something you really want to see. It's the consistency as well, the consistency of it. And what's even more impressive is I personally think is, I think I said this in the video, but from 2017 to 2021, the business over doubled its sales.
Okay.
So its turnover went from 158 million pounds to 353 million pounds from 2017 to 21. So it's doubled its revenue in like a 5-year period, which is awesome, and it's kept its margins good as well. So it hasn't increased sales and decreased margin, because that would be a bad thing, because that would mean they'll be growing at a cost of the business being less profitable. But what's I thought was really impressive is they doubled their revenue in 5 years, but they over quadrupled their profit. Like, that's really, really good. Really, really good stuff. So
why do you think that is the case then? They've doubled their revenue but tripled their profit.
you know what? I think that I'm not gonna like spout and say I know, because I don't. You maybe have to go to the annual report to have a look at that. From top of my head, it might be something to do with operating efficiencies. It only costs them so much to create their product, whether it's manufacturing costs are really low, whether it's because they're selling like a branded product, it doesn't cost a lot for them to make, new content, if you know what I'm saying.
Yeah.
The actual cost behind the business might be really, really small. So by increasing the sales, they're just going to bump up their profit. So that's what, just from top of my head, that's what I think. Don't know what you think anyway. Would you say it's something like that?
Yeah, I would actually agree with you, to be honest. That sounds like one possible reason?
Yeah, so I mean that's the profitability side. Just absolutely amazing. But yeah, with that high profitability comes high return on equity. And a 5-year average is 67%, which is awesome. Yeah, that is ridiculously good. Long-term debt to equity is 24%, and that only increased in 2021. So they actually borrowed, I think it was 40 million pounds. It was. So before that, we had no long-term debt. So 41 million. Excuse me, 41 million pounds of long-term debt. And yeah, with the amount of profit and free cash flow they produce, they'd be able to wipe that out within a few months. So that's not even a big deal. So yeah, basically it's a company which really profitable, low debt, high returns on equity. It's just, in my opinion, it's absolutely wonderful. Obviously it's been growing massively, great capital allocation. Yeah, it does pay a dividend.
Oh, it pays a dividend.
It pays a dividend as well, yeah. I don't know what the yield is. I think it'll be like 2% or something like that. Likely. Yeah, 2.2%. So nice, distributing cash to shareholders. So as well as growing the business, they're able to pay a dividend as well. So not too bad.
That's pretty impressive, to be honest. Like,
it is impressive, yeah.
Paying dividends and stuff like that.
Yeah, I do know this stock has been quite a favourite amongst like fund managers over the past, say, 5 years or so, for good reason. Not like I really care about that too much, because a lot of them just go for the hyped up thing. But out of all of them, this is probably one of the ones they got right. If you look like 5 years ago, when the business was probably it was 5 times. It had half the revenue and 4 times less profit. Yeah, the stock price, this is a really good example of the stock price following earnings and cash flow. So, over time, you'll agree, Wes, that a business, the stock price will follow where the company's earnings and cash flow goes. And this is the perfect example. This is literally the perfect example. From 2017, it was about £10 per share. And now it's like about £75 per share. So literally, because the company is able to grow its profit and cash flow pretty quickly, the share price has just followed it. And I think that's a really good example of that.
Yeah, I agree. And what is your value of this company? What price do you want to buy it at?
Yeah, so I think the reason, we're talking about it today is because, I don't know where I saw it, but I didn't have it on my watch list, but I just saw the share price of it. Like, I think it's like £72. I was like, that's quite close to where I valued it at. Because when I did the video, the company was, I think it was like, £96 per share. So it was a long way off where I valued it at. At the time, at a P ratio of 26. Anyway, yeah, so I valued the company at £69 per share for a 10% return. Yeah, looking at my free cash flow figures, reasonable growth, nothing too major. And also with my fair value, I added back the cash on of the business, the net cash, because I think that's the right thing to do. We value in all the cash going into the future, but if the company's got net cash, I think it's fair enough. You give them the benefit of the doubt. Company has barely any debt, so yeah, £69 per share for 10% return. Happy days. So it's currently at £74 per share, so it's getting close. So I'm just gonna be patient and wait for it to hit. I think not gonna get carried away. It's a company I really do like. I have to did a full video on it. If you want to check it out, go to my YouTube channel. So yeah, solid business. If you get it for a good price where you think you're going to get a good return, I think it'll be a solid addition, really.
Yeah, I completely agree. And for me, It would be nice to hopefully own this company one day, just to get that. Because I don't really own that many UK stocks, so it'd be quite nice. But I'm a long way away from that, to be honest. Because I think my value is, I think, around or 15% return. So I'm just going to be patient on this one.
Yeah, that's fair enough. And the thing is that
$5 or something like that.
both of us have different like required rates of return. For me, it's 10%, and for you, it's like 15%, isn't it? So we're likely going to like similar companies, but a lot of the time you're going to want to buy them at a lower price because, yeah, you want to get a higher return. So and that's more than fair enough. I'm happy with 10%. A lot of them, to be fair, quite a few stocks recently I've been in, I've had a look, and yeah, likely going to be higher, but minimum 10. Getting them out, I'm happy, but it might fall to 45 and I'll be happy as well.
Yeah, you'd definitely be happy if you bought it at 69 and it goes to 45. You get a better average and better upside.
That's it, isn't it? You know, the lower you buy a stock, the bigger margin of safety you've got. The company itself is, at the current price, it's got a P ratio of 20.5. So I think when I buy it, it'll probably be 18, maybe P ratio of 18. So when it gets below that, let's say if it goes below 16, you're then buying it below the historical market average, and then I think you're getting a steal if it's below 15, 16. So yeah, high quality business. If you buy it at a fair price, you should be onto a winner. It's quite simple.
I agree. And anything else you want to talk about in terms of Games Workshop?
I think that's it, to be fair. I think it's quite surprising because it's a UK business, and quite a few UK businesses have not this high quality. So it's just refreshing. I think refreshing is the word, because we spend a lot of our time looking at American companies. I know, I mean, some people want to have UK stocks in a portfolio, but most big companies are global companies anyway, so it doesn't really matter. But it's refreshing to see a UK business which is high quality. So yeah, I think that's, to sum it up, really.
Not many UK companies are high quality like that, are there? So
there's not many at all. Trying to think off the top of my head, especially in terms of profitable, high returns on capital and low leverage. There's a lot of UK companies which are profitable, but a lot of them have a lot of debt as well. So there's all of that to factor in as well. There's a few companies I could think off the top of my head. Diageo, I personally think that's a great company. They make like loads of spirits. If you have loads of spirits brands, they make Guinness as well. If you own Guinness, they're very profitable, but it's consumer goods company, so they have a fair bit of debt as well. So yeah, this company is solid, very solid.
Okay. I think that's it then regarding Games Workshop, right?
Yeah, happy with that. Yeah, definitely.
Okay. Do you know much about Kiwi? Do you know to go that one? Or just briefly touch on it?
Yeah, we can briefly touch on it. I think you did some more numbers on it than me, but I can briefly touch over it. Briefly know a little bit about it. So Kiwi Plc is engaged. So essentially, Kiwi Plc is the Russian version of PayPal. The company itself operates in Russia, Kazakhstan, Moldova, Belarus, Romania, and the UAE as well. So all of that region, it's like, think about PayPal, but in them countries. And I think what attracted us to Kiwi was, well, we all know what's been happening over the past week. It's been absolute chaos. Russia's invaded Ukraine, which is obviously very sad to see. But me and Wes were like, all right, okay, so what's happened to the Russian stock market? It is absolutely collapsed. It has absolutely collapsed. And today, some of the stocks have gone really low, especially the banks and energy. But we were looking and thinking, all right, okay, what stocks have fallen but might be interesting? Because we're not really interested in banks and lots of energy, are we? I own one energy company, but I don't want a portfolio full of oil companies. Really, it doesn't interest me. And that's basically most of the Russian stock market. But we were like, all right, we had a look at Yandex, we had a look at Kiwi, and there's another one, Ozon, I think. Basically, the Russian Google, Russian Google, Russian PayPal, Russian Amazon. But this is the one which stood out of all of them. So yeah, the financials are looking pretty solid for this business. Currently looking valuation wise, well, the Russian stock market didn't even open today, did it, Wes? I don't know if you saw that. So I'm looking February the 25th, which was the last price, but trailing 12-month PE of 2 for Kiwi. Well, there's a good reason for that. It's because the Russian economy is probably going to collapse. So investors basically think all of these companies are going to go to zero. But yeah, the financials wise, it's solid. I haven't done my full analysis on it, but I've got macro trends looking at the key financial ratios. So it gives me a decent indicator of the profitability, the amount of debt, and return equity. And from that alone, I can tell if it's a half decent business or not. Current ratio of 1.5. So it's got more current assets than current liabilities. Solid. Long-term debt to equity, 13%. That's decent. Gross margin of 59%. This is all 2020 numbers, by the way. And looking back over the past 5-6 years, gross margins in the 50s. Net margin last year was 22. 2019 was 12, 11, 15, 13. So last year was maybe a bit of an anomaly, but you're talking 12% margins plus. Isn't that around PayPal? You'll know a bit more than me. Is that similar?
Yeah, around that.
Around that, yeah. So last year was a good year for Kiwi. You know, fintech companies had a really good year. You know, payments code online. You can see why that will be the case. But yeah, good return on equity as well, in the high teens. So yeah, from that I can tell it looks like a solid business. So yeah, I don't know if you have anything to add on the numbers side of things, and when you had a quick look over it.
Not much to say really regarding numbers. I mean, I had a quick look at the 10K. They have good user growth over the last few years, which is good. So it's just unfortunate. It's a Russian company. I feel if it was probably a US company, it would be at a really high price. And
yeah, it would be a hype stock, wouldn't it?
Ratio. When I valued it, I done -3% growth for the first 5 years, then -5% growth, then return rate of 20%, and exit multiple of 0.5, and a buy price at $7.47.
Wow.
And what's the stock price now?
So yeah, the stock price as of now is $5.67.
Yeah. So it's
wow.
A really interesting one, but again, you have to consider the risk. Like Russia is not China or US. There's a lot more to think about, but Kiwis are definitely a high quality company, and if things does change regarding that way Russia operates, it's definitely a company to pay close attention to. But right now, I'm open position and just like monitoring stuff and just seeing how things plays out. But it's definitely a company on my radar.
Yeah, if I could buy it with an ISA, I would. It would be on my watch list right now. Mainly because I think in my head, this situation will come to an end at some point, and you got to think, when are the best buying opportunities for stuff like this? It's a horrific situation that's going on, and the risk is absolutely massive. But for one position in my portfolio, it could be well worth it. There's a large risk of permanent capital loss, but you've got to think, it's not like an oil and gas company or something where they have a lot of debt. Kiwi itself, it looks like I don't know. I seem like I'm waffling a bit, but because it's such a high quality business, what I'm saying is the Russian economy and Kiwi itself will survive in some form, and this horrible situation will be over, whether it's a year, 2, 3, and then Kiwi could absolutely rebound. Not, I don't care about the stock price, more about the business itself. Like the business could do really well, because if this is the PayPal of Russia, Ukraine, Kazakhstan, Moldova, Romania, it's likely going to be around for a good long time, even if this situation doesn't pass for a while.
Yeah, I completely agree with you on that, actually.
But yeah, I can't own it with an ISA, so I'm not particularly interested, and it does make me upset a bit, because there's a few Russian stocks I can own it with an ISA, but I think it's due to the way they're set up, the companies are structured. Because I had a look in Yandex, a company where to look at. Not very good, by the way. Don't look at them. Don't waste your time. Very disappointed. They're the equivalent of Google, but in Russia, and they have other stuff going on as well. But it wasn't a good look when we look at the numbers. But you can buy them with an ISA, but it's because their company is registered in Holland. So, yeah. But yeah, that's Kiwi anyway.
Yeah, I think that's about it regarding them, to be honest. Not much else to touch on. And yeah, next let's talk about this. So, what to do when you're struggling with investing ideas. So, let's say you don't know what to invest in. Like, it's been a while since your last investment. Like, where do you get ideas from in terms of finding new opportunities?
Yeah, so I've got 2 main places I look for opportunities, and I think it's really important just to say, when you're looking for new opportunities, don't blindly copy people, whether it's you see me or Wes talking about stock, whether it's you see some famous investor like Warren Buffett invest in a stock, like Warren, if he invested in Snowflake, for example. Don't get why he invested in Snowflake.
That was actually Ted and Todd,
Ted and Todd, yeah. So yeah, who knows about that one? But anyway, what I'm saying is, what I'm going to say is, just don't blindly copy. That's the worst thing you can do. But anyway, route number 1, 13F filings. So super investors. There's a couple of websites, Datarama and Whale Wisdom. You can find, so for super investors such as Bill Ackman, Warren Buffett, Seth Klarman, all of them, Bill Nigran, there's so many different super investors. You can have a look at their portfolios, because they have to, I think if you're a manager of 100 million, it's $100 million in assets, be it a hedge fund or something like that. But you have to list all your listings. And what I find interesting is looking what these super investors are invested in, and trying to work out what are they seeing in this business and what are the traits of the company. And I think that's a really good way to generate ideas. And a few ideas in my portfolio, I've actually, well, some of them in my portfolio, but a lot of them are on my watch list. A lot of companies on my watch list have come from looking at what super investors invested in. One, for example, I'll give you a good example, Ferrari. So Ferrari, Guy Spear owns Ferrari in his fund. I personally think the valuation is way off, but I totally understand why he would invest in the company. I totally get it. So that's where I got that idea from, funnily enough. Don't have my watch list up here, but yeah, that's a really good place, 13F filings. Another one would be YouTube, Instagram, social media, in terms of there's a lot of content out there, and I was going to say stock screeners, but I think they can be limited in some ways, because they don't show you the full story. We might show you a low PE ratio, which is great, but not necessarily the best place to find some stocks. You might find low valuations, but not necessarily the best high quality companies, in my view. But yeah, YouTube's great. Everything Money. What stocks are they on their 8 pillars? I put all my stocks through their 8 pillars just to have a quick look. Yeah, see what other people are investing in, see if it fits your style, what valuations. Yeah, I don't think I've looked at every company on the S&P 500. That's probably impossible, but I probably looked at the top 100 for sure, or dismissed them straight away.
Yeah, I could pretty much gauge like their overprice like so quickly just by looking at them. So
Yeah, I agree with you. Yeah, 100%. Yeah, I don't know what about you? What do you think in terms of how do you generate ideas?
okay, so for me, I like using screeners. Well, in terms of screeners, I like looking at new 52-week lows.
Okay, yeah.
I like inputting higher return on invested capital, PE under 20, and I like putting revenue growth over like 5%, I think it is, and just seeing what comes up. Normally, I get some good quality businesses, and I just add them to my watch list, and I'll look at them at a later date. Another way, YouTube's pretty good. Follow people who are like-minded like you, and when you do their portfolio reveal, you can just gain ideas from that. Friends as well is another good way.
Yeah.
Like-minded friends is a good way to generate ideas. You can just bounce ideas off each other and ask them why they invested in this company. I think that's about it, really. But yeah, there's definitely different ways you can generate ideas.
Yeah, no, it is good. Look at super investors. Look what your peers are doing online. I think YouTube's fantastic. Yeah, YouTube's a really good place. But in terms of the screeners, what's the best screener, do you think? Because I've used Yahoo Finance many a time and I've not been keen on it. So I don't know what screener you like.
Finviz.
All right, okay.
Yeah, that's the main one that I use, really.
I might need to give that one a shot, so I don't judge screeners so much.
Yeah, but you do get the odd companies. I think like 3 of my holdings came from screeners on Finviz. So,
which holdings were they?
So I think there were Sprouts Farmers Market.
Oh, I like that one. I like that one a lot.
Yeah, Asbury, which is like car retail. They sell cars, used cars and new cars, and they sell car parts as well.
Yeah. Yeah, I remember you saying that one actually.
Yeah, they're like a growth company kind of thing. And Academy Sports and Outdoors, which is like like a sports, like outdoors kind of retail company. Yeah. So yeah, there's certainly some good companies you can find on there. Just have to mess around with all the different metrics.
Yeah, sounds good. I might have to have a look at that one. Yeah. Interesting stuff.
And let's see. Yeah, in terms of like looking at YouTube for ideas, just be careful with what content you look at on YouTube and Instagram, because there's a lot of
hype docs.
Yeah, hype stocks out there, so just be careful, because just because someone is mentioning the same stock doesn't mean it might be a good investment. Just make sure you're doing your research afterwards and come to good judge if it's a good investment or not. But yeah, a lot of people blindly follow social media stocks, and that hasn't worked out well, to be honest, if you look at what's going on in the last year or so.
Yeah, any account which is invested in ARK, just block them.
Most of my stocks, I don't think you can find them anywhere on social media apart from Alibaba, which everyone's talked about because they're scared of what's going to happen, delisting, whatever. Facebook, I mean, everyone knows those 2 companies, but apart from that, I don't think anyone knows my holdings. Like, you can't find them anywhere on social media.
Yeah, that's a good thing, to be fair. Yeah, that is a good thing. Because I mean, if you're investing in stocks like that, which if you've got to think, if you don't know them off the top of your head, then are analysts and Wall Street going to be looking at them as well? So there's that aspect as well, which I think is quite good. Yeah, like remember Warren Buffett always saying that if he was young now, he'd be looking at small caps. He'd be looking at small cap companies and looking for opportunities in the small caps because no one's looking at them. I think Peter Lynch talks about that as well, but I just not for me looking at small caps. Don't get me wrong, I would invest in a small cap. It was a good high quality business, but I don't want to be looking through financial reports to see discrepancies in. I don't really want to be doing that. And I don't think I have to do that to get decent returns, so I'm not going to do it.
Yeah, I do own a few small and medium caps, but it's not because I'm actively looking for them. I just found it because it was good value.
Well, I'll tell you now, Games Workshop, £2.5 billion market cap. So that's technically it's nearly a small cap, isn't it? Isn't a small cap $2 billion, below $2 billion?
I think so. Might be. I'm not sure.
So it's on. So yeah, that's above a small cap, but Games Workshop is at the point where it's nearly a small cap.
Wow.
So it's like, well, I don't discriminate between Facebook and Alibaba are two of the biggest businesses in the world, and I think they're fantastic. But I equally think Games Workshop is fantastic. So just because Games Workshop is a minute size, it doesn't necessarily mean I think, oh, it's rubbish. But a lot of small caps. Yeah, I don't know. I just don't know many small caps really.
Yeah, there's definitely some decent ones out there. Some of them are hard to find on screeners as well. I noticed that. But there's definitely some good ones out there. Okay. Another one. How can someone become a value investor? Say they wanna, learn how to pick stocks, and they got burnt on investing in crappy companies. They want to become a value investor. Like, how can someone what's the first step in terms of learning and changing your mindset?
So yeah, becoming a value investor, that's a really good question. Because it just makes me think how I started. Because I was in a similar situation, but I made money off investing in hype stocks. I made money by late 2017. I think I told you guys, but late 2017, I partook in the first weed stocks hype. It was the first time weed stocks got absolutely hyped up. Basically, on the 1st of January 2018, California legalized marijuana. So basically, for 6 weeks before that, the news were just talking about it all the time. And what happened was, any company which was listed related to marijuana just went to the moon. And I managed to make some decent money from it. Pure luck, pot luck, no pun intended. But yeah, I made some good money off it. I managed to sell at a good time, made a few bob, managed to buy my car with the proceeds. So but I was kind of forced to buy the car because remember the beast from the east, that frost that came, it killed my old car. My car froze over. So I had to buy a new car, so I had to sell the stocks. And it's a good job I did because they collapsed like 6 months after. Anyway, yeah, so I made money from hype stocks, but from there, I had no capital left to invest. So I went out of my way to learn about investing the proper way because I knew that was just luck. I knew that wasn't a realistic way of making money because I think at the time I was 19 and I think I would have been 20 then when I was researching about Warren Buffett. I literally went on Amazon and said, invest in books. So what came up for Warren Buffett were Intelligent Investor, One Up on Wall Street. I started reading. Little Book of Common Sense Investing, that's the indexing book from Jack Bogle. Great books to start with, and not just books, but YouTube. I just went down the rabbit hole of YouTube, and thankfully I didn't get sucked in by Financial Education Jeremy, that idiot, Meet Kevin, that idiot. Don't get me wrong, I watched them. I was watching them in 2018, to be fair, but then I was also watching people like Sven Carlin and Jamie from Learn to Invest. Sven Carlin and Jamie from they were the two that I really like. They were the two OGs, the two OGs of YouTube in terms of value investing. Sven Carlin's a pure value investor. Jamie's not really a value investor, but he kind of is. He is, but he doesn't describe himself as one. But his process is one of about he wants to buy a stock at a certain discount rate, at a certain price, etc. So it kind of is. But his process was really good. Sven Carlin, really good. And then one podcast, the Investors Podcast. I don't know if you've ever heard of it. Was the Investors Podcast? It's the biggest investment podcast. Stock investing. It's branched out into other stuff, but they've got like 300 episodes, and I listen to every single episode. I learned so much. A lot of it went over my head to start with, but if your brain's like a sponge, like mine's a bit like a sponge. If I just absorb so much, it just some of it stays. And even some of the episodes I listened twice. I was like, right, I need to go over that again. Some big fancy words, concepts which I was like, right, didn't really get that, but hey ho, we'll listen to it again. And yeah, whilst I was working or traveling to work, I would listen to them, and that's how I've learned. And yeah, I know I waffled on there, but
So when you first learned about value investing, did it stick immediately, or did it take you a while to fully understand? Because many, like when you first expose them to value investing, it's kind of like some alien weird concept to some people.
Yeah, it was definitely different, and I think what I wanted to understand was why people were investing like that kind of thing. It was like the concept made sense of buying something for less than what you think it's worth at a simple level. That's what we're trying to do. We're trying to buy assets for less than what they're worth. And then I found one thing I found fascinating was Warren Buffett, how we went from to being the richest man on the planet. How that happened, and his story is fascinating. I've read most of the books on him. His biography is fantastic as well. But yeah, anyway, it took me a while, and I feel like I really didn't understand it. I'm trying to think when I started, because it was over a year until I had enough money to invest back into some stocks. So it was 2019. Summer 2019 was the first two stocks I bought after my marijuana shares. It was over a year, maybe 18 months after I sold. Apple and Facebook were the two companies I bought. And I used it's the first time I used a DCF calculator. I used my valuation. I could probably find them somewhere. And what return did I use? I used 8.5% return. Because at the time, that's what Jimmy from Learn to Invest was using. So this just shows that I was still learning. I was still learning about investing because I copied his discount rate. So I copied his discount rate. I put my own free cash flow figures in, but I came to a figure and I bought Apple and Facebook. So they were the first companies I bought. And then there was a few others I bought after that. And then I think I told you, but after the March 2020 crash, I didn't sell in the crash. I think I sold everything in. What I did was in May 2020, I sold my holdings and started fresh again, because what I invested in, I really realized that I didn't really know what I owned. And over the past, it's going to come to 2 years now, I've been on this journey of just trying to understand what I am as an investor. And I think I found that now, what companies I want to invest in, high quality businesses at a fair price. But it's taken me ages. It's taken me a long time. So, and we will keep evolving, but you will get to a stage where you know where you know where you stand. It's not taking you long at all, has it?
No, I think it clicked with me instantly. Like the first, when I first got exposed to it, I think it was from Everything Money because, you know, I found Sprouts Farmers Market on the screener, right?
I wish I found them earlier because they would have clicked earlier.
And I just searched them on YouTube to see what other people wanted to say about them, and I found Everything Money, and when they had this process, like it was just alien to me. I was like, what is this? This is not how I used to invest. And then they started like valuing the company. I was like, okay, this is weird. And then they start talking about Warren Buffett, and then I just went on from there, like read about Warren Buffett, read about value investing, and then I was like, yeah, this makes sense to me. And then over a few months period, I just sold everything, sold out everything clean. And then I started slowly, like doing it, just slowly, just shifting towards more value, decent value companies. But in terms of like the companies that I wanted to invest in, it took me a while because I did invest in some companies that were good value, but at the same time, there were ones that I'm 1,000% confident in because I'm new to this. So. But now I'm 1,000% confident in terms of like the value companies that I want to buy and hold for a really long time. It clicked with me instantly, and it took me a while to get used to the DCF and the mindset and stuff like that because it is a whole different way of investing.
What I've learned over the past 2 years is, so I think I understood the valuation side of things. And I understood I need to buy things under what I think they're worth. But what I've been learning myself is a quality business. That's what I've been really putting a focus on, is a quality business. Because there was a time 18 months ago where I owned AT&T. So I bought AT&T. I can't remember when I bought it. But I bought AT&T because it was below what I thought, I think 10% return. I think I was like, all right, okay, I think it's a decent price here. But when I was owning it and I was researching more about it, the company itself has more debt than some countries. And there's no joke. Them and Volkswagen have like so much debt. They have like over 200 billion in debt. Do AT&T, or I think something around that figure. Those companies in my portfolio I owned were a good valuation, but I realised there wasn't good enough quality. And when you don't think something's good quality in terms of a company you own, I'm quite big on quality and the valuation now. That's what I've really learned myself. So let's say Alibaba and Meta, they are some of the highest quality out there. And it just happens that the valuation is as well. But those companies I owned, and there's also a few companies I owned which I bought, I thought they were undervalued, but I hadn't used the same process. So my process now is refined. I've got like a 4-step process. I want it to be my valuation 10% return or higher, and I go through my quality checks. So quality checks and valuation done. I was I can't remember. Do you know anything about basketball? New York Knicks. There's a company listed which owns them. Madison Square Garden Sports. So that company owns the New York Knicks, the New York Rangers hockey team, and it also owns the stadium as well. And I bought that. This one's going to sound really stupid, but I'm saying it because I think it's useful. I bought that company because the market cap of the company was like $3 billion. But I was like, all right, if you add up the assets, if you Google what the Knicks worth, it's like $5 billion. And the stadium's worth $1 billion and the Rangers are worth $2 billion. So I was like, all right, some of the assets, this company should be worth $10 billion. But that wasn't the right way to go about it. You know what I mean? So, but I learned that and I was like, right, that's wrong. I'll sell. So, and I did something similar. I did something similar with Empire State Realty Trust. So the company is the REIT which owns the Empire State Building. So the Empire State Building, you can Google how much you think it's worth, but the REIT was trading quite low at some point, and I was like, all right, I think this REIT is trading a lot lower than what I think it's worth, because the Empire State Building is like, anyway, so I bought it for the wrong reasons. I thought it was undervalued, but I didn't use my process properly for it, and that's why I sold them. And now I'm at a point now where I'm really, really happy with my investing process, and I can sleep at night. I've got my watch list full of companies, and I'm really, really happy with it. But it's taken me quite a few years to get here. So, yeah.
I think having an investing process that you stick to and follow is really important, because it helps you during bull markets and bear markets. So, yeah, it's really important to have a process.
100%. I'm not afraid to say I invested in two companies like that, because that was a learning experience for me. I don't think I lost too much money, if not I gained money, but who cares? It is what it is. I now know my process. I know exactly what I'm investing in, why I'm investing in it. High quality businesses at a fair price, using my analysis checklist process, which I go through on my YouTube channel. But it's all about learning. You know, I don't know how you're 26, are you, Wes?
Yeah, I'm 26.
Yeah, I'm 23. So we're learning. We're still learning about all this. So is there any companies that you invested in which you thought, oh, you look back at?
I mean, when I used to invest, in all the hype stuff, that I look at what the price I bought it and then look at the price now, and I just think, I would have literally just destroyed my portfolio if I've held on to them, because the price difference is just insane. But in terms of like companies that I bought based on a value, not really. Most of the companies that I bought were just hype ones.
That's fair enough.
Yeah.
Because when I was buying them companies, it was kind of like I thought I was doing the right thing, and I thought I was being clever doing it, but I did learn, and I came to realize, and I think that's when I found Everything's Money channel. I can't remember what the first video watching them was, but when I watched it, they were like, "You've got to have a process," and I was like, I looked through all my stocks, I was like, why do I own that? It's not the right way to do it, but it's all a learning thing as well. It's a learning thing, and it's a good job that I'm at that stage now where I'm really, really confident about the process, and I think it'll do me well over the long run.
Yeah, I completely agree with you, and having a process just makes you block out the things that don't make sense to you, and that's what you want. You want to just block out the nonsense and just stick with what does make sense.
Yeah, that's exactly it.
Yeah, and so how would you say the mindset, in terms of the mindset, because there's a lot that goes into being a value investor in terms of the mindset. What do you think is the most, do you think you've got the correct mindset that will do you well over a long period of time?
Yeah, personally, I think I do. I think I really do. I think one thing I've realised about myself is I'm always, I think everyone should be continuously learning, but myself, I think I'm always learning, and I'm quite level-headed. I'm quite level-headed as well. I don't make rash decisions. I think I have the right temperament as well. Not everyone does. I don't get in a panic. I don't frolic if a lot of people panic for no reason over, not just about investing, but in life in general. Like, some people, if the car broke down, they'd have a fit on the street, whereas me, I'd be like, it is what it is. You know what I mean? You could have that cool, level-headed temperament, I think, to be an investor. You can invest in index funds. If you don't have the right temperament and you can't handle it, just go to index funds or ETFs, whatever. You need to be level-headed and a good temperament. The way I describe it is ice. You need ice through your veins. You need to be like a cold ice killer. because it does take a lot of doing. But when you get in the good mindset, that when a stock goes down, that it's actually a really good thing for you. It's so powerful, stuff like that. And what I think is interesting is what helped me with my mindset was looking at what famous investors, Warren Buffett has done. It's been proven over long periods of time that these processes do work. Joel Greenblatt, Warren Buffett, Peter Lynch, just all these people have been successful. So why can't we do something similar in our, using proven ways of value investing?
Yeah, exactly. Like value investing does work over a long period of time. The only reason why it won't work for you is because you don't have the correct mindset. Like the first time you see underperformance, where you might go 1, 2, 3, 4 years of underperformance, like that's when people tend to give up, and they give up at the wrong time. You just have to stick with your stocks that you know are really undervalued, because value does take time to show. It's not something that will come overnight. It might take 4, 5, 6 years for that one stock to actually show value, and you just need to be patient, stick with the process, and not deviate.
Yeah, something related on that is I think I mentioned too in the DMs, but I've invested into an ETF called EMQQ. It's an emerging markets ETF which focuses on internet and e-commerce companies. I think I sent you the top 10 holdings or something, but anyway, 52% is in China, and so this ETF, I'm currently down 35%. So I'm down 35% on this ETF. So the vast majority is China, and the top 10 holdings is Tencent, Alibaba, Reliance Industries, Maitan, JD.com, Mercado Libre, Prosus, Pinduoduo, Baidu, and Sea Limited. So I don't know about top subas, but I'm in this ETF, and I personally think emerging markets are going to be a great place to be. Well, you do as well, because you've got a lot of your money there. Maybe because it's good valuations as well. But this ETF has come down a lot. But out of them top 10 holdings, a lot of them I think are horrifically undervalued. So I think that ETF will rebound over the long run. And I'm going to put more money in. I'm going to put my money where my mouth is as well, and be like, I'm down 35%, but I really don't care. Them top 10 names alone, okay, Mercado Libre, maybe a bit stretched. I don't know what it. I haven't had a look. That's. Have you heard of them?
200 times earnings or something. 300 times earnings.
Mercado.
They just turned profitable as well.
Yeah, so they've just turned profitable. So yeah, it's a high P. So yeah, it's probably not good. They're a high thing in the ETF, but the majority of them are the Chinese internet and tech companies. So where's it gone? I don't know. But yeah, most of the top holdings are the Chinese companies which have been battered. So I'm not too worried, to be totally honest. And this company is from Reliance Industries in India, and just some. I can get the full holdings list up, but like I said, I think that's going to do well over the long term, and I'm sticking with it. So
yeah, I completely agree. I do like the holdings like JD, Alibaba, and Tencent, Prosus. Those are some solid companies that will do well in the future.
Basically, the way I see it is, it's an emerging markets ETF, but it gets rid of the industries like banks, insurance. It's basically emerging markets, where it's focusing on internet and e-commerce. But when I looked at the holdings and I looked at the businesses itself, well, half of them are Chinese. So you're basically investing into half the ETF is full of the Chinese companies which are undervalued, and the rest of them is a bit of a bonus. And a lot of them are going to flourish into, profitable businesses anyway. So
yeah, it's a good bet to have.
So yeah, I'm happy with it anyway, and yeah, we'll see how it goes. But yeah, I'm gonna invest more into that, because yeah, I'm happy with that. So yeah, I thought I'd just bring that up anyway.
Yeah. What do you think is the most difficult thing about value investing?
I think the most difficult thing is people, the mainstream people, when you talk to people, they think, why are you invested in British American tobacco? Why are you investing in Square? Why are you investing in these hype stocks? No, for me, it's when I speak to the general public, they think, oh, why don't you want Tesla and Neo? That's literally the first thing they ask me, and I just like shut my eyes and I go.
It's hard to explain to them.
It's hard to explain to the normal person who isn't like a value investor.
Yeah, because a guy from my work, like, I told him I like this company, and then he said, "What do you think of Tesla and Neo?" Because he owns them both actually, and I can't really explain to him why I'm not invested in them because he's not gonna understand.
Well,
so
the way I describe it to people is, if I was going to sell you my iPhone, would you pay 10 grand for it?
Yeah.
If I'm going to sell you my iPhone today, Wes, you need to give me 10 grand right here, right now.
No chance. I'm not paying 10 grand for an iPhone.
Exactly. If you want to buy, a 100 grand house, let's say I've got a 100 grand house, right? Right. I'm going to put a price tag of $1 million on it. Are you going to buy it?
No.
That's exactly what Tesla is at the minute.
Yeah, it's just...
That is the way I describe it to people, and people still don't get it. They just think, oh, it's a fast-growing company, it's whatever. I think Tesla as a company is brilliant. I think they're doing fantastic things. The numbers are starting to improve. It's looking, you know what I mean? They're starting to improve. Not something that I don't like car companies, so I won't invest. But fair play to them. They're making it a profitable business now. But the valuation is just unwarranted. Trillion or whatever it is. It's quite frankly ridiculous. Yeah. Not much to say on Tesla.
Do you think this is another difficult thing about value investing? Watching other people make money on things you don't like you avoid.
You see, that for me doesn't bother me because I don't really care what other people do. That might sound a bit I'm up myself on my own backside, but I'm generally not. If someone makes 10x on a stock, I really don't care. But the thing is, as well, if I make a lot of money on a stock, I don't expect people to be like, "Oh, Lewis is the best." You know what I mean? I don't. You shouldn't be too bothered what I do, and I don't really care what. You know what I mean? So that's the other thing. I don't really get envy or jealous on stuff like that. I'm just not bothered because a lot of the time as well, I just know it's luck.
Yeah.
It's not, you haven't done anything special to do that. You've just got it at the right time, and well, good for you. You got your return, but it doesn't mean you're like a invest market wizard now, does it?
Yeah. And do you think value investing is old-fashioned?
Definitely not. Definitely not. And when the crash comes, it will be in fashion. And when we show our juicy returns.
A lot of people say it's like last 10 years he hasn't done well. It's underperformed, and maybe it's dead, and it's old-fashioned. We shouldn't be having this mindset like people in like the 50s, like, you know.
Yeah, the only thing which is dead is I think the Ben Graham style of value investing is dead. The old
cigarette butt, right?
Cigarette butt, price to book. If the company was liquidated, you're going to get more than what it's currently trading for. That side of things is done because of intangible assets. If you look at a company like Facebook, what physical assets do they have? All of our assets is intangible. They don't have a physical factory. They probably have some offices. They maybe lease most of the offices. What assets? They probably have more cash than actual like physical assets. That cigar butt approach is done now. But the principles, like, we spoke about a few lives ago. We spoke about Mr. Market. We spoke about invested in the business. They're timeless and they will be here forever. But yeah, even Ben Graham says he had updated versions of his books, and he said in the 70s that even then the cigar butt approach was just coming to an end. And I think a lot of that came down to the access of information. So back in the 30s and 40s, like trying to find out about these companies you had to do the work. You had to look through the books and stuff. Whereas now, I could find a company from Timbuktu on Yahoo Finance within a minute. You know what I mean? So, more is known about everything, but value investing is timeless, and the returns have shown that. Warren Buffett effectively getting a 20% return year on year since the 50s. Joel Greenblatt, his little book formula, basically, I won't go into too much detail, but there's two, it's like a screener. It looks for companies with return on equity above 15%, and I think a PE ratio below a certain number, and you buy them once a year, and then in a year's time you sell them and you buy the same category of stocks again, and over the long term that beats the market. It's been proven in his book basically talks about it. Valuation is the most important thing when it comes to stock investing. It's simple as that. You could buy the worst company but a good valuation, and it can beat all these high flyers. So what I'm trying to do is combine high quality with that valuation.
Yeah, that's the same thing I'm trying to do as well. Completely agree.
Yeah.
What about this? Do you find it difficult to do nothing when you're a value investor?
Yeah, I kind of do, to be fair, because
I'm
trying to think. I bought Smith & Wesson, spoiler alert, and I did buy Alibaba. I bought Activision in November. Then before that, I can't remember. So I don't buy all too often. So yeah, I would be buying more if I had more cash coming in. So I think of this year, I'm aiming to get more money in my ISA and stuff, and then maybe from there I might be looking at more opportunities. But I'll be probably buying more of what I've got, most likely. So yeah, what about you? What do you struggle with that?
Not really. I mean, I'm kind of like patient, where I'm just waiting for opportunities, but I'm always looking for investing opportunities. But it's been a while since I bought something.
Yeah.
And I'm like, are things gonna ever like come down? Like we just had the market just go down a bit, and there's literally no new opportunity that has arisen from the last 2 weeks. But it's just a waiting game, really. But I'll wait however long it takes. But it's been maybe around 4 months since I last bought a new position. What I've been doing is just buying what I've currently got, just buying more shares at a cheaper price than what I've got.
Yeah, and I think with you in your position, because you want a higher return, so there's going to be less opportunities.
Yeah.
So let's say, for example, a company that we're both probably like the look of is 3M. I personally like the look of them anyway. It's getting close to what my 10% return is. It's getting there. It hit the price, but I didn't decide to. Last week when for about 1 day the market was in the red. It was Tuesday, wasn't it, when we woke up and Russia invaded. That was the only day when the market was in the red, and then it went up after that. It hit the target price, but I decided, right, okay, I'm going to see if I can get a bit of a better return here. I'm confident it might go down to that 120 mark and I get 12% return. And I think that'd be quite a decent number. So I'm holding out. I'm holding out for that. But yeah, if 15% return is what you're looking for, there's generally going to be less opportunities. But you're likely going to own less stocks in your portfolio than me, so that maybe doesn't matter so much. So
yeah, that's true. But it depends really. Like if I am willing to start small position at 12% return, and then if it does go down further, hey, I just increase it.
Yeah.
If it doesn't, I'm happy with the 12% thing. But
yeah, fair enough.
I didn't realize 3M went down that much to hit your buy price.
Yeah, it got to 140. Yeah,
Really, damn.
It got to 140 on Tuesday, but then it's gone up a little bit since then. But yeah, if I can get it at between, I'll have a look what 12% is. But yeah, if it gets to that, I think it'll be getting put in my portfolio because I personally really like the business. I really like the business. Even if it has 4% revenue growth, I do like the business. So yeah. 3-4% would be perfect revenue growth for them.
Yeah, I agree. They're good, high quality company to pay a nice dividend as well.
Decent dividend king, which is great. It for me that just shows the company's been around a long time and it's done the business. I've done a video on it actually. We've got a lot of patents as well. Like I know a lot of the products you may think, all right, they can be made cheaper elsewhere, but they've been around for a good 100 years. So yeah, I just quite like the business itself. So
yeah, completely agree. So in terms of like, you know, resources to get into value investing, what books or like YouTube or like investors would you say people should try and follow to learn?
I think investing with Wes. apart from us two, the main three, I would say, everything money to start with. They have a no nonsense approach to it, which I really like. I really like it. Some people get offended by it, but I don't. I think it's fantastic. They're straight to the point with it, and to be fair, they do make it quite easy to understand. Learn to invest in Jimmy. He's decent. I'd probably say everything money's better, mainly because he's more value investing in everything money. So I think it drills it into your head a bit better. Sven Carlin's good as well. Once you've watched a lot of everything money, watch Sven Carlin because he's fantastic as well. He really knows his stuff. He's a proper value investor as well. Avoid the 4 horsemen of doom. Meet Kevin. Avoid him like the plague. Avoid financial education Jeremy like the plague. They both like Tattooed Chef. It says everything you need to know. Graham Stefan and Andre Geek. Graham Stefan's the best one out of them all, but I don't know why he stoops down to their level. But anyway, yeah, you just need to tread lightly on YouTube because there's a lot of idiots on there. So, what's he called? Tom Nash. Oh, he's an idiot. Does my head in. Palantir. Oh my God. Yeah. There's a guy, a UK one as well. He does my head in. Oh, some of them just honestly do my head in so much because we just don't know what they're talking about. And we've got big followings as well. And it's scary. Some of them have got big followings as well.
Oh, really? Oh, damn.
Yeah, all these Meet Kevins have got millions of followers. Yeah. So
I don't know that many UK YouTubers actually like investing channels.
Yeah, there's a lot of finance and investing, general investing, but in terms of if you individual stocks and value investing, there's not too many. That's what I'm hoping I can become the UK go-to value investor. That's my plan. Anyway, that's what I'd like to do anyway, because there's a lot of Americans and stuff, but there's not too many UK-based ones. So hopefully that can be me.
Yeah, I think you have the potential to do that, fill that void.
Hopefully, yeah.
You have good content, so yeah, we'll see. And yeah, for me, in terms of like channels that I would recommend, Everything Money. I like Jimmy as well. Sven is good. I like someone called J Money. He's a value investor. Who else is there? I like New Money's pretty good. He's an Australian.
Yeah, I've seen him before. He's good.
Yeah, there's another Australian. I like Frank Tedber as well. He's another Australian.
There's a guy from New Zealand as well. I can't remember what his name is. Yeah. He does stuff on Charlie Munger all the time. I always see it pop up on my homepage.
Oh, I can't remember his name.
Investing with something. I can't remember what it's called, but there's quite a few. So yeah, just keep,
Yeah. In terms of like super investor that I like to follow, I like, Buffett, Charlie Munger. I like Howard Marks a lot. I like Seth Klarman a lot. Those kind of like investors. And in terms of books, Intelligent Investor, Little Book That Beats the Market's pretty good. Richer, Wiser, Happier. There's a few good books to learn from and get yourself in the right mindset.
100%.
Yeah, and if you're thinking of becoming a value investor, just stick with it and keep learning. Don't be afraid to make mistakes because you will learn from it.
100%. 100%. Like me buying Madison Square Garden Sports because they own the Knicks. But you live and you learn, don't you?
Exactly. Let's see, if there's anything else. Let's see.
Yeah, I think I'm gonna have to get off anyway. We've been on for over an hour, but
yeah.
Covered
everything actually. Covered a lot.
We have done, yeah, gone through quite a lot. So
Sasha Yanshin. Sasha. I think that's the New Zealand one you're talking about.
Sasha Yashin's the UK one who annoys me a lot. Yeah.
Oh, I've not heard of that YouTuber.
Google him after Wes and watch some of his videos and let me know what you think. It's clickbaity and some of the stocks he recommends are awful. Tesla, Fiverr. Lucid. Lucid's even worse than Neo and Tesla because it has no revenue.
He's got the fire background,
Yeah.
exploding.
I respect the hustle, but I don't respect him in terms of knowing what he's talking about in terms of individual stocks like that. He has some good videos calling out YouTube and stuff, but then he goes ahead and does stuff like that. So just watch some of them and let me know what you think.
Yeah, I'll give him a watch after this. But yeah, I think that's everything we've covered really. Does anyone have any questions before we head off or anything? Give this a minute, see if there's any question. Doesn't look like it actually.
Yeah, we all good then?
Yeah, but yeah, thanks for watching. Hope you enjoyed this week. We'll see you next week, Monday. And yeah, thanks for watching, everyone.
Yeah, thanks for watching, everyone. It's been another good live. So yeah, see you again next week.
Bye.
See you later, mate. Bye-bye.